Many people try to learn from Warren Buffett, but fail to make money. Perhaps it's because they haven't grasped the essence. Today, let's explore a core question. How can we determine the best time to buy stocks? This content is based on Benjamin Graham's classic book, The Intelligent Investor, and delves into the safety margin of stock investing. Imagine you bought a company's bonds. If the company makes $10 million a year, but only has to pay $1 million in interest annually, it can easily repay its debts even if the market crashes. This is the safety margin, a protective cushion. Similarly, if a company has assets worth $50 million and liabilities of only $10 million, it can still repay its debts by selling some assets even if its cash flow dries out. This situation of assets far exceeding liabilities represents a high safety margin. Stocks are more complex than bonds, but the principle is the same. The cheaper you buy, the higher the safety margin. Graham said that if a company's total profit over 10 years, minus its debts, still exceed half of its current market value, then the stock is extremely valuable. If the market value is within 11 times the profit, it's also a good opportunity. However, these criteria are no longer applicable in today's market. The market environment has changed dramatically, and even Graham himself admitted in later revisions that the original calculation methods could no longer find sufficient safety margins. His star student, Warren Buffett, further improved these methods, shifting from the cigar-food strategy to finding companies with excellent management and long-term growth potential, holding them for the long term to reap substantial returns. Buffett's success proves that specific investment methods may become obsolete due to changes in time and environment, but the underlying investment philosophy and logic never go out of style. Graham's safety margin theory is still worth learning, especially its emphasis on the principle of buying at a relatively low price. The biggest losses for investors often come from buying low-quality stocks during bull markets. These stocks may rise quickly in the short term, but they lack financial support, and once the market reverses, they are the first to lose their bubbles. Graham was particularly wary of great stocks without safety margins, especially those that are highly valued despite being unprofitable. Although today's tech stocks seem to have broken this traditional notion, only a few can truly turn losses into profits. For ordinary investors, the safety margin is the key to protecting themselves from significant losses. Graham also realized that the basis for judging the safety margin is past performance, which cannot fully represent the future. Therefore, he emphasized the importance of diversified investing, spreading funds across dozens of similar stocks to reduce the risk of a single stock. In this way, even if a black swan event occurs, investors can weather the cycle and outperform the market. The core of the intelligent investor is that the essence of investing is not about managing money, but about self-control. Letting go of emotions and illusions and returning to value and fundamentals is the key to successful investing. Buffett's success is not accidental, but because he inherited Graham's investment philosophy and optimized it according to the changes of the times. Like and follow us to help you find the safest time to buy stocks and master the capital market.